What if I told you that a single individual played a pivotal role in triggering the greatest financial crisis since the Great Depression of 1929? That his extraordinarily risky decisions and unwavering stubbornness led not only to the downfall of a 158-year-old bank, but also set off a domino effect that nearly dismantled the global financial system. Richard Fuld, the final CEO of Lehman Brothers, is often depicted as the primary antagonist of the 2008 financial crisis, known as the Gorilla of Wall Street. His story is one of boundless ambition, unchecked power, and a troubling blend of arrogance and willful ignorance that cost the global economy trillions. Under his decisive leadership, Lehman Brothers morphed from a respected institution into a high-risk gambling machine that, when it collapsed, erased the savings of countless families and destabilized the entire financial system. The enigmatic rise and catastrophic fall of this financial empire tell a story so surreal it could be mistaken for fiction, yet it is hauntingly real. Prepare to delve into a gripping narrative that unveils the inner workings of Wall Street, where unchecked greed and innovative yet reckless decisions combine to create the perfect storm, forever altering the face of modern capitalism. This is the account of how one of Wall Street's most storied banks became the largest bankruptcy case in American history, and how its historic collapse continues to shape the financial world to this day. It raises a critical question. Have we truly learned anything from this debacle? Richard Fuld's fascinating journey in finance began in an unconventional way. After serving in the U.S. Air Force and graduating from the University of Colorado, he joined Lehman Brothers as a trainee in 1969, a decision that would not only shape his life but also redefine the global financial landscape. His initial role as a commercial paper trader revealed his sharp analytical skills and keen instincts for negotiation. Fuld quickly distinguished himself through his innovative approach to maximizing outcomes. Fuld's early career was marked by an almost obsessive dedication to his work, arriving before everyone else and leaving long after. He absorbed wisdom from market veterans with an unparalleled thirst for knowledge. His competitive and determined nature caught the eye of senior executives who recognized his potential. Within his first years, he developed a profound understanding of financial market dynamics, particularly in fixed-income trading, laying the groundwork for his reputation. Even in his early days, Fuld's intense demeanor, later a hallmark of his leadership, was evident. Known for his strong personality and remarkable resolve, he earned the nickname the Gorilla of Wall Street. These formative years helped shape his financial philosophy and establish critical industry connections. His decisions, deeply rooted in thorough analysis and almost instinctive market insight, laid the foundation for his meteoric rise. Fuld's exceptional ability to unravel market complexities and identify trends set him apart. His innovative trading strategies drew the attention of his superior, who entrusted him with increasing responsibility. By his fifth year at the firm, he was leading teams and crafting his trading strategies, an impressive feat for someone so young in the institution. His early career coincided with a transformative era in American finance. The end of the gold standard in 1971 and subsequent deregulation provided fertile ground for shrewd traders like Fuld. Armed with sharp intelligence and adaptability, he seized every opportunity to expand his influence within the bank, earning a reputation as one of his generation's most talented traders. Fuld's natural curiosity about market mechanics drove him to devise systems and strategies that revolutionized trading operations. He was among the first to recognize the potential of emerging financial technology, implementing innovative systems that significantly improved efficiency. His ability to think outside the box and take calculated risks made him a standout among his peers. By the late 1970s, Fuld's extraordinary performance and leadership skills propelled him into positions of greater responsibility. He began participating in strategic decisions that revealed his deep understanding of the bank's global operations and broader financial trends. His growing influence and forward-thinking vision prepared him for the rapid ascent that awaited him at Lehman Brothers. Richard Fuld's extraordinary climb to the top of Lehman Brothers remains a compelling narrative in financial history. After proving his prowess as a trader, he steadily ascended to pivotal roles within the firm. By the early 1980s, his assertive nature and leadership skills led to his appointment as the head of fixed-income trading, a position rarely achieved by someone under 40. The 1980s presented unique challenges that tested Fuld's adaptability. During the 1987 stock market crash, his calm demeanor and strategic decisions helped Lehman Brothers navigate turbulent waters. His ability to remain composed during crises and his drive to deeply understand market movements cemented his role in the bank's strategic direction during volatile periods. The bank underwent a significant transformation in 1984 when it was acquired by American Express. Fuld's adaptability shone as he thrived during this corporate transition, navigating the new dynamics while building strategic alliances. By 1990, his leadership capabilities earned him the co-CEO position of the fixed income division, where he delivered record profit, implemented structural reforms, and cultivated a high-performance culture admired across Wall Street. Fuld's innovative approach to management and remarkable execution skills became evident when Lehman Brothers separated from American Express in 1993. His strategic vision played a crucial role in re-establishing Lehman as an independent entity, solidifying his reputation as a financial leader. In 1994, Fuld was named CEO of Lehman Brothers, marking the pinnacle of a career characterized by groundbreaking achievements and bold decisions. At just 48, he took the helm of one of Wall Street's oldest institutions, armed with an ambitious vision for modernization and aggressive global expansion. His tenure promised to usher in a new era for the bank. Fuld's first years as CEO were marked by transformative successes that reshaped Lehman Brothers. Between 1994 and 2000, he oversaw an impressive increase in the bank's market value, expanding it from $2 billion to over $30 billion. His strategic initiatives included entering lucrative sectors like private equity and asset management, diversifying the bank's operations globally. Under Fuld's visionary leadership, Lehman Brothers became a major player in emerging markets, establishing significant operations in Asia and Europe. His foresight in navigating the complexities of these regions led to successful expansions in countries such as China and India. By 2003, Lehman was thriving. Posting record profits fueled by the real estate boom and sophisticated financial operations. Fuld cultivated a corporate culture that rewarded excellence with generous bonuses, fostering a competitive and results-driven environment. However, the seeds of future troubles were sown during this period of unbridled success. The bank's growing reliance on high-risk ventures and exposure to the housing market created vulnerabilities that would later prove catastrophic. What seemed like an unstoppable success story would soon unravel into one of the most dramatic collapses in financial history. Between 2004 and 2007, Lehman Brothers underwent a drastic shift in strategy, diving headfirst into the subprime mortgage market. Richard Fuld, with his characteristic drive to explore new profit avenues, led the bank into amassing a massive portfolio of real estate assets and higher-risk mortgages. This aggressive approach, while innovative, turned Lehman into one of the most heavily exposed institutions in the housing market. The real estate boom created a euphoric atmosphere that masked the inherent risks. Lehman developed increasingly complex financial products, transforming risky mortgages into seemingly safe securities through sophisticated financial engineering. Instruments like collateralized debt obligations (CDOs) and mortgage-backed securities (MBS) became central to the bank's operation, propelling its growth while embedding significant vulnerability. The intricacy of these financial products left many investors, and even some within the bank, unaware of the full extent of the risks involved. Lehman's use of leverage reached unprecedented levels, operating at a ratio of 30-1, meaning for every dollar of equity, the bank had $30 in borrowed funds. While this amplified profits during the market's highs, it also made the institution extremely fragile during downturn. Lehman's relentless pursuit of profits led to increasingly reckless practice. Executive pressure to meet ambitious targets began loosening risk assessment criteria. The risk management division, once a critical counterbalance, lost much of its influence as high-stakes decisions took center stage. This was akin to constructing a monumental structure on an unstable foundation. The bank's dependence on the housing market became a glaring weakness. As long as home prices continued to climb, the model appeared flawless. Profits soared, bonuses skyrocketed, and Wall Street applauded. However, this concentration of risk left Lehman dangerously exposed to any downturn in the real estate market. By 2006, early warning signs began to emerge as cracks appeared in the housing market. Despite growing instability, Lehman doubled down, maintaining its aggressive stance. Fuld and his leadership team, convinced of their ability to weather any storm, dismissed concerns, a decision that would later be regarded as one of the most critical missteps in financial history. As 2007 unfolded, the housing market began to unravel, with rising mortgage defaults signaling deeper problems. While other banks started pulling back, Lehman maintained an unyielding optimism. Fuld presented a confident front to investors, assuring them that the bank was well prepared to navigate temporary turbulence. Internally, however, the picture was far more precarious. Questions about Lehman's exposure to subprime mortgages and the quality of its assets grew louder. Bank used controversial accounting practices, such as the now infamous Repo 105 transaction, to temporarily offload debt and present a healthier balance sheet. These measures created a facade of stability but masked underlying vulnerability. The leadership's refusal to acknowledge the severity of the crisis was striking. Even as competitors reported significant losses, Lehman's management insisted the worst was behind them. This disconnect between internal realities and public messaging would become emblematic of the bank's collapse. By 2008, the situation had reached a boiling point. Lehman's stock value plummeted, and the cost of insuring its debt soared. Desperate efforts to stabilize the bank, including selling assets and courting potential investors, failed to restore confidence. Talks with potential acquirers such as Bank of America and Barclays ultimately fell through. The tipping point came in September 2008. Over a fateful weekend, top Wall Street executives and government officials convened at the Federal Reserve Bank of New York in a last-ditch effort to prevent Lehman's collapse. Unlike earlier rescues, such as the bailout of Bear Stearns, the U.S. government declined to intervene, citing a need to set a precedent against perpetual bailout. On September 15, 2008, Lehman Brothers filed for bankruptcy, marking the largest corporate failure in U.S. history. The collapse sent shockwaves through the global financial system, triggering a chain reaction of panic and destabilization. Markets plunged, credit markets froze, and economies worldwide began spiraling into recession. The aftermath of Lehman's fall was unprecedented. Governments around the world scrambled to implement emergency measures to stabilize financial systems. Massive stimulus packages, bank bailouts, and coordinated central bank interventions became the order of the day. The crisis laid bare the vulnerabilities of an interconnected financial system and forced a reckoning with decades of deregulation and risky practice. For Richard Fuld, the collapse marked a dramatic fall from grace. Once celebrated as one of Wall Street's most powerful figures, he became the poster child for corporate hubris. Despite his insistence that he had done everything possible to save the bank, public outrage was palpable. Congressional hearing, investigative report, and media scrutiny painted a picture of leadership failures and missed opportunities. The legacy of Lehman Brothers' collapse continues to shape the financial world. It spurred sweeping regulatory reforms, such as the Dodd-Frank Act, aimed at preventing future crises. Concepts like too big to fail were scrutinized, and systemic risk became a focal point for policymakers. Yet, the question remains, could it happen again? The rise and fall of Lehman Brothers remains a cautionary tale, a stark reminder of the dangers of unchecked ambition, the fragility of complex financial systems, and the enduring consequences of ignoring the lessons of history. The collapse of Lehman Brothers left a profound and indelible mark on the global financial system. Beyond the immediate panic and chaos, it exposed deep structural flaws within financial institutions and regulatory framework that had gone unchecked for decades. As the dust settled, it became clear that the fallout would reshape not only Wall Street, but also the very principles underpinning modern capitalism. The systemic impact of Lehman's bankruptcy reverberated across the globe. Financial institutions, already on edge due to mounting subprime losses, faced a liquidity crisis as interbank lending froze almost overnight. confidence evaporated, and even institutions with limited exposure to Lehman began to falter. Governments and central banks worldwide were forced to intervene with unprecedented measures to prevent the financial system from collapsing entirely. One of the immediate responses was the creation of massive bailout programs. In the United States, the troubled Asset Relief Program (TARP) injected hundreds of billions of dollars into banks to stabilize the system. Central banks slashed interest rates to near zero, launched quantitative easing programs, and provided emergency funding to ensure that credit markets did not seize up entirely. These extraordinary interventions underscored the interconnected nature of the financial system and the necessity of coordinated global responses. In the wake of the crisis, regulatory frameworks underwent dramatic overhauls. The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, sought to address many of the issues that had contributed to the meltdown. Key provisions included stricter capital requirements for banks, limits on proprietary trading under the Volcker Rule, and enhanced oversight of derivatives market. Globally, the Basel III framework introduced higher capital and liquidity standards to ensure that banks could withstand future shocks. The culture of Wall Street also came under intense scrutiny. Lehman's collapse highlighted the dangers of excessive risk-taking and short-term profit-driven strategy. Financial institutions were compelled to reevaluate their compensation structure, governance practice, and risk management protocols. While progress has been made, critics argue that many of these changes have been superficial and that the fundamental drivers of the crisis, greed, over-leverage, and insufficient oversight, still persist. For Richard Fuld, the aftermath was a personal and professional reckoning. Once one of Wall Street's most revered figures, he became a symbol of corporate excess and mismanagement. Congressional hearings interrogated his decision, with lawmakers and the public demanding accountability for the billions lost by investors and the devastating economic consequences felt by millions. Despite his attempts to defend his leadership, Fuld's reputation was irreparably tarnished. The broader societal impact of the Lehman collapse and the ensuing financial crisis was profound. Millions lost their jobs, homes, and savings as the global economy spiraled into the Great Recession. The crisis exacerbated income inequality and eroded trust in financial institutions and government, fostering widespread public disillusionment. Movements like Occupy Wall Street emerged as a response to the perceived injustices of the financial system, channeling public anger into calls for greater accountability and reform. Yet even as the financial system stabilized in the years following the crisis, questions lingered about the lessons learned. Core regulatory reforms have strengthened some aspects of the system. Skeptics warn of complacency and the potential for history to repeat itself. The rise of shadow banking, continued innovation in financial products, and the sheer size of systemically important institutions remain sources of concern. Lehman Brothers' fall also serves as a stark reminder of the dangers posed by unbridled confidence and the failure to acknowledge systemic risk. The decisions made by its leadership, particularly under Richard Fuld, illustrate the consequences of prioritizing short-term gains over long-term stability. The bank's aggressive pursuit of profit, coupled with its refusal to adapt to changing market reality, ultimately sealed its fate. Today, Lehman Brothers is studied as a cautionary tale in business schools, regulatory agencies, and boardrooms worldwide. Its legacy is a powerful lesson on the importance of humility, foresight, and accountability in financial leadership. It underscores the need for constant vigilance, robust risk management, and a commitment to ethical practices in an industry where the stakes are often unimaginably high. The collapse also transformed the discourse around financial crises, prompting greater focus on systemic risk and the potential consequences of interconnected markets. Governments, regulators, and institutions now grapple with how to balance innovation and growth with the need for stability and prudence. In the end, Lehman Brothers' downfall is more than just a story of one bank's failure. It is a microcosm of broader issues that continue to challenge the global financial system. It serves as a reminder that, in finance as in life, hubris and overreach can lead to catastrophic consequences. As the world continues to grapple with the implications of that fateful September day, the story of Lehman Brothers remains as relevant as ever, a stark warning of what happens when ambition, risk, and denial collide. The story of Lehman Brothers does not just linger as a memory of collapse, but as a critical chapter in the evolution of the modern financial system. Its bankruptcy marked a turning point that forced a re-evaluation of what resilience in global finance truly means. The aftermath rippled through countless industries, affecting economies, institutions, and individuals in ways still felt today. One of the most striking legacies of the Lehman collapse is its role in sparking a decade-long conversation about systemic stability. Policymakers, regulators, and economists have since grappled with questions about the balance of risk and reward in financial markets. Can innovation coexist with safety? Should certain institutions be allowed to grow so large and interconnected that their failure becomes unthinkable? The term "too big to fail," often debated in the years following the crisis, encapsulates these challenges. Lehman Brothers, notably, was the exception to this principle, a decision by regulators to allow its bankruptcy rather than orchestrating a bailout. This choice has been analyzed endlessly, with some arguing that it restored market discipline, while others contend it exacerbated the financial panic and deepened the recession. The financial reforms that emerged post-Lehman, including Dodd-Frank in the United States and similar frameworks worldwide, aim to address these dilemmas. Stress tests, higher capital requirements, and living wills for large institutions are now standard. These measures are designed to prevent future collapses from cascading into global crises. Yet critics point out gaps in implementation and enforcement, warning that the financial sector's inherent complexity makes it impossible to predict or contain all risk. Lehman's fall also changed the dynamics of central banking. The Federal Reserve and other central banks took on unprecedented roles as lenders of last resort, directly intervening in markets to provide liquidity and stabilize economies. Quantitative easing, once a rare and unconventional tool, became a standard response in times of crisis. While these interventions helped stave off economic disaster, they also raised questions about the long-term effects of sustained low interest rates and expansive monetary policy. On a more granular level, the collapse of Lehman revealed the fragility of financial products and the dangers of opacity. Instruments like mortgage-backed securities and collateralized debt obligations, once celebrated as innovations, were exposed as vehicles of hidden risk. These revelations prompted a push for transparency in financial markets, with new regulations requiring better reporting and oversight. However, the continued evolution of complex financial instruments means that vigilance remains essential. For Richard Fuld, the legacy of Lehman Brothers is inseparable from his own. While some view him as a scapegoat for systemic issues, others see him as emblematic of Wall Street's excesses during the pre-crisis years. His leadership style, defined by aggressive expansion, a culture of loyalty, and an aversion to dissent, has been dissected in countless books, documentaries, and academic studies. His story serves as a reminder of the human factors: pride, ambition, and blind spots that can amplify institutional risk. Lehman's employees also faced lasting consequences. Thousands of careers were derailed, and many lost significant personal wealth tied to the bank's stock. For years, former Lehman bankers carried the stigma of association with the firm's collapse, even as they rebuilt their careers at other institutions. Despite the bank's historic downfall, many retained a sense of pride in the institution they had once helped build, reflecting the complex emotions surrounding its legacy. The cultural and societal impact of the Lehman collapse extended beyond finance. Public distrust of banks surged in the years following the crisis, fueling populist movements and calls for greater accountability in corporate governance. The crisis also widened the wealth gap, with recovery efforts disproportionately benefiting financial markets and wealthy investors, while ordinary workers faced prolonged unemployment and stagnating wages. On the academic front, Lehman Brothers has become a cornerstone case study in business ethics, risk management, and crisis leadership. Students around the world analyze its rise and fall to understand the interplay between innovation and oversight, ambition and prudence. The lessons drawn from Lehman's story continue to shape the training of future financial leaders, regulators, and policymakers. Looking ahead, the collapse of Lehman Brothers raises broader questions about the sustainability of modern capitalism. How can markets balance short-term gains with long-term stability? What safeguards are needed to prevent future crises in an increasingly interconnected world? These questions remain as pressing today as they were in 2008. While the financial system has undoubtedly evolved in response to the crisis, Lehman's story serves as a cautionary tale, a stark reminder of the perils of unchecked ambition and the devastating consequences of systemic failure. Its legacy is not just one of collapse, but also one of lessons learned, changes made, and challenges that persist. The fall of Lehman Brothers is, ultimately, a story of contrast. Extraordinary success followed by catastrophic failure, brilliance marred by blindness, and innovation undone by greed. It is a story that will continue to be told, studied, and debated for generations to come, a defining moment in the history of finance and a reminder of the fragility of the systems upon which the global economy rests. Dick. If you found this story fascinating and want to dive deeper into the world of finance, don't forget to like this video and subscribe to our channel. Your support helps us bring more captivating content straight to you. Turn on the notification bell so you never miss an update. Thanks for watching, and we'll see you in the next one.